Hello everybody, this is AK. I'm back. So this morning I published a new blog post and it's on about my third quarter 2024 passive income, right? The full third quarter passive income received from my investment portfolio, right? Which includes equities, T-bills and Singapore savings bonds. Of course, there's something new, right? That in the last 1 year, like more than 1 year by now, I've been buying Singapore savings bonds and T-bills, and they are part of the investment portfolio. So, third quarter 2024 passive income came in at $85,223. $85,223, and year on year, this is slightly lower, right? Because third quarter 2023, I received $85,307. So there's an $80 reduction. So year on year, I see an $80 reduction for third quarter passive income. Well, it's a negligible difference, right? Almost negligible difference, but it's still a dip, right? It's still a dip. The reason is because I sold a big chunk of my investment in Sabana REIT, and I blog about this. I made a video about this, right? I drastically reduced exposure to Sabana REIT. And so, Sabana REIT was one of my largest investments. So losing that largest investment, well, most of that largest investment had a big impact on my passive income, right, for the quarter, right? However, it's an $80 reduction. It's a big impact, but it's only an $80 reduction year on year. What happened? Well, it's all thanks to the higher dividends received from my investments in DBS, OCBC and UOB, right, the local banks. So the impact is mitigated. And the money from the sale of Sabana REIT, in case you're wondering, has gone into my T-bill ladder to strengthen my T-bill ladder. So basically my war chest, so my war chest has become stronger, and I'm in no hurry to deploy the money, because like I've said so many times before, I'm already substantially invested in the stock market, right? So if we look at the investments which contributed the most to my passive income in third quarter 2024, the first three will of course be the banks, right? OCBC, DBS, UOB, no surprises, right? OCBC is my largest investment in my portfolio. All right. Unless we decide to count CPF as well, which I think of as a bond, and CPF will be the largest, followed by OCBC. Right, OCBC, the investment in OCBC is almost the same size as my investments in DBS and UOB combined, so it's the biggest contributor to my passive income. And but DBS is going to generate more passive income for me going forward because of the bonus issue, which in effect gives a 10% uplift to dividends received, right? And UOB is just being UOB lah. UOB kiam siap, conservative and plodding along, but still more than decent enough return, so can't complain, right? In case you don't want to listen to me ramble and talk to myself, I'll leave a link in the description box below to the blog post I published this morning, so you can read at your own leisure. Okay, so anyway, just to continue now, in a recent video I did say that I will not be adding to my investments in the banks when their share prices hit all-time highs, right? And I will wait for pullback in prices before adding. And I also made in that video I explained why, right, about how interest rates coming down would have an impact, and I used DBS as a case study, going into the numbers with a bit more detail to show how we could see profits coming down next year, all else being equal. Okay, so I would wait for a pullback in prices before adding. And to be fair, OCBC and UOB still look inexpensive, at 1.2 or 1.3 times book value. But interest rates come down, they will be similarly impacted, right? So if we really have to invest in the local banks, and we have not done so yet, OCBC and UOB are probably good places to start. Okay, so the fourth largest contributor to my passive income in third quarter 2024 is REIT Global. REIT Global. And many people might be wondering what's my position on REIT Global now. I'm still invested, but I'm not adding, not yet. In a recent reply to a reader, I said this: REIT Global's Berlin property will be vacant for 12 to 18 months very soon. So sometime next year, you'll be vacant. The vacancy will start, and there'll be no income generated by the Berlin property then, and income has to be impacted negatively, right? That's a realistic expectation. There is also the point that I have made many times with regards to REITs, and that's they will be refinancing in a higher interest rate environment, even though there are 6 or 7 rate cuts coming by end of 2025. And in fact, the rate cuts are, they're expected to go on into 2026. REIT Global has to refinance by 2026, if I remember correctly. So, and I've made videos about this before, and how I would not be adding to my investments in REITs, including iREIT, unless unit price should go down much lower, right? And like I said, to be fair, this higher interest rate environment would not affect just iREIT. It will affect any REIT, right? And so I'm not interested in putting more money in any REIT right now, right? And my recent videos on banks and REITs made this very clear. And also in my podcast with the fifth person, I said as much, that my focus is on income and valuation, how the income is generated for investors. I'm not so much interested in the prices, right? So, so if you have not watched the podcast I did with the fifth person recently, I'll leave a link in the description box below as well. There's a segment on where we talk about banks and REITs and why I think banks are more attractive investments than REITs. It's not about prices, okay? In the latest update that REIT Global provided, they revealed that they were in the final stages of pre-letting the Berlin property, and it involves a hotel and a long-term stay hospitality operator. So, and REIT expects to double the asking rent. Right, this confirms what I said before, that the Berlin property is undervalued. Right, it's severely under-rented. Right, so the old tenant that vacated the property, they were paying rent which was at least 50% below market rate. Right, so which was why when they extended the lease by 6 months, the old tenant, they had to pay more than 40% increase in asking rent. Right, so I still feel that the Berlin property is undervalued, and if the REITs management does a good job, we should see value unlock. So as for interest rates, well, REIT Global's gearing ratio is very low, still very low. I mean, relatively low compared to other S-REITs, and their borrowing costs would most likely increase when they refinance, but their low gearing would soften the blow, right? It will soften the blow. As for my investment in REIT Global, it is experiencing a big paper loss, and I reviewed as much in a not too long ago. I reviewed as much, is nursing a big paper loss, because the price suffered a 40% decline. I think I said since the beginning of the year or last year. I can't remember exactly. Anyway, I say it's nursing a big paper loss, and I said nursing and not suffering, because the REIT is still paying me a meaningful dividend, right? Even as Mr. Market feels pessimistic about it. right? And at the current unit price, the distribution yield is about 8+%. And because I like I said, I feel it's still undervalued. There's no need for me to sell. There's no reason to sell, and I'm quite contented to be paid while I wait for things to improve. And of course, that is something that I do all the time with many of my investments, which are suffering a temporary dislocation, that kind of stuff. And am I going to buy more? Well, if Mr. Market should go into a huge depression and offer me a 10% distribution yield for REIT Global, all else being equal, I would most probably buy more. 10% distribution yield, double digit yield, distribution yield, and all else being equal, that means no strange circumstances which might push things down south. I mean things as in the fundamentals down south. Then 10%, all else being equal, I'll probably buy more, right? And because a very simple reason is because it'll be very similar to the earnings yields offered by our local banks then, right? Our local banks are offering like earnings yield 10%, 11%. So if REIT Global should offer a distribution yield of like 10% or more, that's similar to the earnings yields offered by our banks, and I think that's attractive enough, right? And I say all investments are good investments at the right price, and the right price is not a static number, right? It should change if circumstances affecting it should change, and it should also change if we do comparative analysis when we compare one investment to another investment, which one will give more bang for our buck, right? So the last thing I want to talk about, number 5, and that's AMES APAC REIT, right? I cannot end this by session without giving AMES APAC REIT a mention, right? Yes, I've been invested in AMES APAC REIT since the global financial crisis, and it is still one of my largest passive income generators after so many years. It's one of my largest investments, and I know I've said this many times, and I'm going to say this again. To me, this is a risk-free investment, right? Because I've recovered all my capital many years ago, right? The unit price can go up, go down, and it wouldn't affect me at all, right? But for people who have recently invested in the REIT, or for people who are thinking of investing in the REIT, please be aware that the REIT has perpetual bonds, right? When I first invested in it, like during the global financial crisis, it didn't have perpetual bonds, right? So it means that the REIT, even though their gearing level on which they report seems to be quite okay, their effective gearing level is higher when you take the perpetual bonds into consideration. So invest in the REITs only if we feel comfortable with this. Right. So, but having said this, to be fair, the REIT is well run and enjoys a tailwind as logistics real estate, which the REIT is mostly about, remains in high demand. So as long as they are able to keep increasing the asking rent, then things should be okay, right? So if AK can talk to himself, so can you. Bye bye.